Hi, this is Brian Resney, President of Resney Wealth Management. I've been getting a lot of phone calls, emails, and of course also on my radio show in regards to what is a true financial advisor. I had a call on the show last week from a gentleman that basically went to a bank, then he went to a brokerage house, and unfortunately both places try to sell him the same kind of investment, a variable annuity. So I thought I would talk a little bit about what a true investment advisor is and does, and also the 5 major warning signs. You can check your brokerage accounts to know if you really have a true advisor and if you're being really advised at all. These are the top 5 warning signs to know if all you really have is a salesman selling you investments. Now, you may have somebody that calls you once a quarter, gives you a touchy-feely kind of a feel about your portfolio, but at the end of the day, are they really just calling to sell you another investment product, or are they actually continuously researching, managing, and making appropriate changes to your portfolio? Let's get right into the top 5 warning signs. Number 1, variable annuities. If you've been sold a variable annuity, or the person that you're talking with wants to sell you a variable annuity, there is a high likelihood that person is simply a salesman for the products they sell. Variable annuities are one of the highest paid commission investment products on the street. Obviously, that's the reason a lot of these brokers and insurance agents sell them, simply because of the commission. Unfortunately, the majority of variable annuities are poor consumer products, in my opinion. They have extremely high fees, back-end surrenders, and simply do not allow you, the investor, to get full benefit of the investment that you are trying to invest in because of the fees you have. These investments are sold. They are not bought. If you have a variable annuity in your portfolio or somebody's recommending that you buy a variable annuity, in my opinion, I would get a second opinion. Number 2, the equity index annuity. This is one of the hot poster childs that has come on the street in the last 8 to 9 years. There's a lot of people doing free lunch seminars, make stock market returns, they claim, have access to your money. Simply not the case. Equity index annuities are another one of those. In most cases, simply do not make sense for the consumer. Most of the equity index annuities that I find, again, carry huge high commissions for the selling agent who's selling it. Unfortunately, you, the investor, is put to the back of the line. Most of these products have 12, 14, 16, and even as high as 20-year surrender periods to get all of your money. Any investment that is truly high quality should give you instant access to your money today and not carry front-end or back-end loads. Unfortunately, because of the high commission structure equity index annuities offer, in addition to variable annuities, brokers or so-called advisors and insurance agents love to sell them. The other thing you want to watch for in your brokerage account is structured products. Investment products that your brokerage house represents or essentially creates. And what I mean by that is, I had a gentleman that came in a couple weeks ago. He was working with a major Wall Street broker or broker-dealer. I looked in his portfolio. What was interesting is half of his portfolio were all structured products or created products by this brokerage house. Most of these products were very mediocre at best. Unfortunately, because this person worked for this or had an account with this large brokerage firm, the broker was selling him a lot of the sponsored or created investments the brokerage house sells. Good for the brokerage house, good for the broker. Unfortunately, not good for Mr. Consumer. The next one are mutual funds. Look at your portfolio. Primarily, if most of the mutual funds in your portfolio are from one fund family or 2 fund families, that is another warning sign. I had a call last week. A gentleman had about a $1.7 million portfolio. All of his money was in American funds. Now, not that American funds are bad funds. They actually have a couple decent funds. But unfortunately, American funds does not have the best, in my opinion, in each asset category, whether it's small cap, large cap, value, growth, bonds, international, emerging markets, and so on. But because this person was working with a brokerage firm that sells a lot of American funds, his whole portfolio was made up of American funds. And unfortunately, there was no objective advice in that portfolio. There was other funds out of the 8,000 funds out there that were much better than what he had. But unfortunately, because of the broker he was working with, or so-called advisor, this advisor put him all in American funds. And at the end of the day, that's not objective management. And unfortunately, he was really missing out on some high-quality investments if proper and independent research was done. The next warning sign that you really want to watch out for is this in your portfolio. The mutual funds that you do own, are they B-share and C-share mutual funds? Brokers and so-called advisors love to sell B and C class share mutual funds. These are the mutual fund share class that carries the highest commission, also carries continuous high back-end 12B1 fees, and may have back-end surrender penalties. They have a very high expense ratio, and at the end of the day, the more money that's going out for fees and commissions to the broker or brokerage house, the less money that you have the possibility to make. So look at your broker statement, and if you have the XYZ mutual fund and it's a C class or B class, again, that's another warning sign. So let's run through them. If you have variable annuities, if somebody's trying to sell you an equity index annuity, if somebody's trying to sell you a sponsored product that's created by that brokerage house, if you have mutual funds all by the same fund family or two fund families, that's another warning sign. And number 5, B and C class share mutual funds in general. These are the 5 top warning signs that I look for when I look and review a potential client's portfolio. This is how you can look at your portfolio to know if the advice you're really getting is objective. Do not be lulled just because a person seems nice and may have good intentions. Unfortunately, the environment that they work in may force them to sell commission-based products that are not in your best interest. One of the great ways to really protect yourself, in my opinion, is use a fee-only registered investment advisor who is independent, who does not get involved in any of these deceptive sales practices, in my opinion. One of the ways you can know if the person is fee-only and is acting as a fiduciary, you can use our fiduciary questionnaire. It's a generic questionnaire. You can use it on your potential advisor or advisor you're using now to really figure out how they're compensated and if they work in your best interest. Remember, fee-only, independent, registered investment advisor, in my opinion, is the only true form of advisor. That person would work as a fiduciary in your best interest. If you need help with your portfolio, if you're concerned that maybe you're not getting proper advice and it's not objective and right for you, you can always call our office for a second opinion, and we are here to help you build your portfolio in a manner that is right for you. Have yourself a great day.